Somebody recently asked me how much money they would have to invest in dividend stocks in order to earn around $100 a month in dividends. Now, this is a popular question that I see throughout the internet and throughout the dividend investment community quite often because it is a good question. The $100 per month goal is a goal that I think all dividend investors at one time or another can share. But this question got me thinking, what is the least amount of money needed invested in a stock or ETF in order to earn that $100 per month in dividends? Now, in order to figure this out, we would first need to figure out exactly how this whole thing works. For an investor that's looking to spend the least amount of money as possible, that investor would need to find very, very high yielding stocks or ETFs. Now, dividend yield is a financial ratio that measures the annual dividends paid out to shareholders relative to the current market price of the stock. It is expressed as a percentage and can be calculated by dividing the annual dividend per share by the current market share price. So in this video, we're going to go through and I'm going to share with you 3 different high-yielding ETFs in which an investor could buy and earn $100 a month in dividends. But the interesting part of this is, this investor would not need to spend that much money at all. Most likely much, much less than most of you think. So the first investment vehicle that we're going to go through is SLVO. This is the Credit Suisse Silver Shares Covered Call ETN. Now, the Credit Suisse X-Link Silver Shares Covered Call ETN is an exchange-traded note launched by Credit Suisse. The note seeks to track the performance of the Credit Suisse Nasdaq Silver Flows 106 index, and the index represents the commodity markets across the globe. It takes long and short positions to represent the iShares Silver Trust through covered call options. SLVO definitely had to make the list of extremely high-yielding investment instruments in order to earn $100 a month in dividends for very, very cheap, because this fund yields 19.47% as far as a trailing 12-month dividend yield, which is much higher than pretty much every single stock and most ETFs in existence. Now, keep in mind that dividend yield is just the trailing 12 months, and of course, an ETN like this is going to pay out a different amount likely every single month. But for argument's sake and for the video's purpose, this is definitely one of the highest yielders out there. So in order to figure out how much of SLVO you would need to invest into in order to earn $100 a month in dividends, you would have to take the annual payout, and again, this is the trailing 12-month payout of $15.89. If you were to divide $15.89 divided by 12, you would receive on average, and again, just trailing 12-month wise, $1.33 per share per month that you would receive if you invested into SLVO. So next what we would do is we would divide 100 by $1.33, which is the monthly payouts, which gives you 75.18, which is how many shares of SLVO the investor would need to buy. So if you multiply that by 81.64, which is SLVO's current share price, an investor would need to only invest over $6,100 into SLVO in order to earn $100 per month in dividends. The next extremely high yielding instrument that could earn you $100 per month in dividends without investing all that much money is SVOL, or the Simplified Volatility Premium ETF. Now, this ETF invests in public equity and fixed income markets in the US. For its equity portion, the fund invests directly and through derivatives in stocks of companies operating across diversified sectors. It employs short strategy and uses derivatives such as futures and options to create its portfolio. And when it comes to SVOL, the trailing 12-month dividend yield is 17.71%, with an annual payout trailing 12-month of $3.87, which is significant for a very, very cheap ETF. Now, although SVOL hasn't been around all that long, just a few years now, the monthly dividends that it's paid are actually surprisingly consistent. And this is one of those riskier ETFs, in my opinion, that I would actually even nibble on, because so far it's actually returned a very, very decent total return, and we're going to go through this later. But if you were to divide $100, which is your monthly goal, by the 32 cents on average that one share of SVOL pays you every single month, you would need around 312 shares. Now, the crazy thing is that their shares are only $21.88 per share, So that means you need to invest, in theory, $6,837.50 into SVOL in order to earn $100 a month in dividends. And the dividends for this one seem pretty consistent. The last ETF that we're going to go over, and this is a popular one, I'm sure you guys are all familiar with, JP Morgan's JEPI ETF. Now, JEPI's trailing 12-month dividend yield is 11.47%. JEPI doesn't have a super consistent payout every single month because of the strategy that it employs, but overall, JEPI pays somewhere around 40 to 50% on average. But now to get into the math for JEPI, if JEPI pays around 45 cents per share per month, you would need around 222 shares in order to earn that $100 per month in dividends. Now, JEPI currently costs around $54.34, which means you would have to invest around $12,075 into the JP Morgan equity ETF in order to earn that $100 per month in dividends, which is the most expensive investment out of the three. Now, as I'm sure you guys can follow so far, these investment options are most likely not the best investment options for a long-term investor, but definitely give you an idea of the possibilities out there and a fun way to really see how much the least amount of money invested in different holdings could earn you $100 per month in dividends. But this is most important right here. What is the total return long term? So the total return equals the share price plus the dividends paid. So year to date, JEPI's return a total return of 1.34, S&P 500 7.34, SLVO minus 2.94, and SVOL a positive 4.44. So as you can see, out of these different options, even though some of them are yielding over 15-16%, you would have been better off year to date, in this time frame at least, to just buy shares of the S&P 500, which is a good lesson overall. Now, on the year time frame, JEPI has a minus 1.76% total return, S&P minus 8.39% total return, SLVO minus 4.5%, and SVOL actually has a 7% positive total return. So in the 1 year time frame, SVOL is absolutely crushing the rest because of this market's volatility in this time frame. Now, over the 3 year time frame, which we can stop right there because SVOL hasn't even been around for 3 years, but the total returns are 40.93% for JEPI. S&P wins at a 54.11%, and SLVO at 41.74%, SVOL at 13.27%. So it's quite interesting as you look at these different options as far as total return goes on the long term. It's pretty impressive that some of the really high yielding instruments do actually have a decent total return on multiple different time frames. But as dividend investors and investors in general in the stock market, it seems to always come back to the S&P 500, which does return the best return in most time frames. And this is because it's very, very tough to beat the S&P 500. It's actually almost nearly impossible. If you guys enjoyed this video and you want to see more videos like this in the future, make sure to please drop a like in the video and subscribe for more. Thanks as always, guys, and I'll see you in the next one.